The 2025 housing crisis is no longer a warning. It's happening right now, and it's hitting harder than the 2008 meltdown. Forget Wall Street. This time, Main Street is the epicenter. Across the U.S., home prices are tanking, inventory is exploding, and foreclosures are creeping back like a silent plague. In this video, we reveal 5 American cities teetering on the edge of collapse. From Atlanta's investor-fueled unraveling to Florida's overpriced nightmares, these housing markets are spiraling into dangerous territory. If you think your city is safe, think again. The signs are all there, and the crash is coming faster than anyone expected. Number 5. Atlanta, Georgia. Is the 2008 housing crash repeating itself here? Atlanta, a sprawling urban magnet for newcomers, is witnessing its once red-hot housing market plunge into a rapid, chilling decline in 2025. Between 2020 and 2022, Atlanta experienced one of the nation's most violent price increases, with median home values rocketing from $260,000 to over $420,000, a jaw-dropping 61% gain. But now, with mortgage rates stubbornly hovering around 7%, those monumental gains are terrifyingly evaporating, turning into agonizing losses for countless homeowners. Inventory has surged by 34% year over year, and homes are lingering on the market for unconscionable periods, especially in once coveted suburban areas like Marietta, Alpharetta, and Decatur. Affordability has become a pervasive, inescapable nightmare. Atlanta's median household income sits around $71,000, yet monthly mortgage payments on an average home now grotesquely exceed $2,800, a figure that doesn't even include insurance and property taxes. This crushing burden is slamming countless first-time buyers out of the market. Coupled with recent property tax hikes across Fulton and DeKalb counties, the cost of living, once a distant bargain, is now a brutal financial reality. A critical, terrifying factor contributing to Atlanta's current vulnerability is the immense, unchecked influx of investors during the pandemic. At one point, over 25% of all home purchases were by institutional buyers. Now, many of those rental properties are being aggressively dumped back onto the open market as the Airbnb gold rush has utterly failed and profit margins have shriveled. Vacancy rates are escalating, especially within high-density developments and newly constructed subdivisions. Atlanta's diverse economy is also facing severe headwinds, with prominent tech layoffs and a noticeable, chilling slowdown in the burgeoning film industry making headlines. Concurrently, pervasive traffic congestion, critically strained infrastructure, and rapidly rising crime rates in some areas are making parts of the city actively undesirable, further complicating this catastrophic housing situation. Foreclosures are also subtly, terrifyingly creeping back, showing a 22% increase from 2024, disproportionately gutting lower-income neighborhoods already ravaged by inflation and job loss. The painful, haunting memory of the 2008 housing crash, which savagely impacted Atlanta, lingers like a ghost, and many fear a chilling sense of history violently repeating itself. While Atlanta's real estate market isn't in full collapse yet, it is undoubtedly wobbling on the brink. If economic uncertainty deepens and interest rates don't budge, this southern powerhouse could face a protracted, agonizing market reset that will destroy livelihoods. For Deltona, Florida, the quiet town that's headed for a shocking housing collapse. Deltona, a central Florida city often ignored in national real estate discussions compared to its flashy neighbors, is quietly and horrifyingly emerging as one of the most acutely vulnerable housing markets of 2025. This one sleepy suburban town experienced a dramatic, unsustainable population and housing surge during the pandemic, as remote workers fled big cities for the illusion of affordable suburban life. The median home price in Deltona soared from a modest $210,000 in 2019 to an astonishing $370,000 by 2022, a stunning 76% increase. But that rapid boom has now decisively stalled, with chilling signs of impending doom visible across every facet of the market. One enormous underlying issue is job access. Deltona functioned predominantly as a commuter town, with the majority of its residents trapped traveling to Orlando or Daytona for work. As gas prices relentlessly climb and the prevalence of remote work diminishes, this commuter lifestyle is becoming an impossible, untenable nightmare. The city utterly lacks a robust local job base, and with a median household income of just $55,000, the soaring, crushing cost of home ownership, often exceeding $2,400 per month, including taxes and insurance, is pushing countless families to the brink of total financial collapse. Inventory in Deltona has ballooned by an alarming 41% year over year, and price cuts are now an epidemic, with more than 45% of active listings already brutally reduced. The once-tight market is now thoroughly, catastrophically saturated with homes that simply aren't moving. Foreclosure filings have also ticked up by 19% since 2024, and several new subdivisions are experiencing terrifyingly rising vacancy rates. The statewide insurance crisis, while often linked to coastal areas, has profoundly, devastatingly impacted Deltona. Average annual homeowners insurance premiums now exceed $5,500, a crushing, unsustainable burden for lower-income households. This financial shock is causing many buyers to withdraw in horror during escrow once they grasp the true, exorbitant cost of ownership. Investor interest, which once foolishly fueled much of the demand here, is now rapidly waning. Short-term rentals are no longer profitable, and rents have plateaued, forcing landlords to sell off properties and further exacerbate the already saturated supply. Deltona may lack the glitz of Miami or the diversified job base of Tampa, but its housing market is demonstrating profound, terrifying instability. If interest rates remain high and the local economy doesn't miraculously pick up, Deltona could tragically transform from a quiet success story into a painful, unforeseen collapse that will shock the nation. 3. New Orleans, Louisiana. The Big Easy's housing market is turning into a big bust. New Orleans, a city renowned for its intoxicating jazz rhythms, soulful spirit, and defiant resilience, finds its housing market desperately struggling to maintain its beat in 2025. After a fleeting post-pandemic real estate surge, the market is now rapidly, horrifyingly decelerating, and undeniable cracks are beginning to rip through its very fabric. The median home price in New Orleans increased from $230,000 in 2020 to approximately $320,000 by late 2023, a 39% rise. But now, prices have started a chilling dip. Listings are languishing on the market for unacceptably long durations, and buyer demand has dried up faster than a Mardi Gras float after parade. A monumental, soul-crushing issue for homeowners in New Orleans is a relentless, terrifying surge in insurance premiums, primarily driven by severe, escalating climate risks. Flood insurance alone can cost upwards of $3,000 to $5,000 annually, and when combined with standard homeowners coverage, total yearly costs can easily exceed a devastating $9,000. This crippling, unsustainable expense is effectively pricing out the very working-class residents who give New Orleans its soul, particularly in neighborhoods like Gently and New Orleans East, where median incomes average around $45,000. When insurance becomes impossible, homeownership quickly collapses. The city's aging, fragile infrastructure adds another layer of existential stress, with perpetually challenged sewer and water systems, widespread, bone-jarring potholes, and frequent, maddening power outages during storms. This, combined with significant, oppressive property tax burden, creates a perfect, volatile recipe for housing instability. Many homeowners are reluctantly, desperately choosing to sell, but critical, agonizing shortage of buyers persists, exacerbated by interest rates exceeding 6.8%. The average monthly mortgage payment on a modest New Orleans home now surpasses $2,200, consuming more than 50% of the average household's income. New Orleans also grapples with persistent, alarming population stagnation. The city is yet to fully recover from post-Katrina migration losses, and now younger generations are once again fleeing in search of better job opportunities, enhanced safety, and greater affordability elsewhere. Elevated crime rates in certain districts are further terrifying potential buyers, and job growth remains sluggish in the city's tourism-dependent economy. Foreclosure rates in New Orleans have risen by 24% compared to last year, and the city is among those specifically flagged for potential value corrections in 2025. Without substantial economic stimulus or a fundamental, revolutionary reform of its insurance market, the Big Easy could transform into a big, catastrophic housing bust. This cultural treasure still shines brightly, but beneath its vibrant surface, New Orleans is a city of profound, imminent risk of housing collapse if the prevailing pressures continue to mount. 2. Denver, Colorado. The mile-high city's housing market is on a collision course. Denver's housing market, once perceived as an unstoppable, high-flying force of rapid growth, a thriving tech scene, and an enviable outdoor lifestyle, is in 2025 unmistakably, terrifyingly tumbling down the slope. Home prices in the mile-high city soared dramatically from approximately $390,000 in 2019 to a peak of $620,000 in 2022, a jaw-dropping 59% increase. But that formidable mountain of value is now conspicuously, horrifyingly crumbling. The median home price has since plummeted to about $580,000, and a chilling consensus among analysts predicts a further 10% to 15% decline by 2026 if current trends violently persist. Inventory in Denver has surged by a significant 36% year over year, and sellers are resorting to desperate, drastic price reductions, with over 50% of homes listed in spring 2025 having undergone at least one price cut. With mortgage rates hovering around 6.7%, many prospective buyers have simply been forced to retreat in despair from a market. The average monthly mortgage payment on a median-priced home has ballooned past an astounding $3,800, yet Denver's median household income is only around $85,000, making homeownership feel more like an unattainable, cruel luxury than a realistic life step for many. While Denver's job market remains fundamentally strong, it is undeniably, chillingly slowing down. Tech layoffs, particularly impacting Boulder and downtown Denver, are severely gutting younger professionals. Major companies like Meta, Amazon, and various local startups have implemented significant, brutal staff reductions, and many remote workers who initially flocked to Denver are now desperately seeking more affordable states. Concurrently, rents have flattened, prompting landlords to reevaluate their investment portfolios. Institutional investors, who once voraciously acquired homes at scale, are now beginning to offload properties, adding even more listings to an already critically crowded market. Rental vacancy rates have climbed to 6.5%, marking the highest level in nearly a decade. Other growing, terrifying concerns regarding urban livability, such as increasing homelessness, pervasive, soul-crushing traffic congestion, and crippling high local taxes, are rendering certain neighborhoods actively undesirable. Simultaneously, new construction continues unabated, with thousands of apartments and single-family homes reaching completion, exerting additional, destructive pressure on an oversaturated market. Foreclosures in the Denver metro area have spiked by 21% since 2024, disproportionately affecting first-time buyers who overextended themselves during the peak market frenzy. Denver may still offer breathtaking views and an enviable lifestyle, but its housing market is undeniably headed downhill fast, and the brakes appear to be failing catastrophically. Number 1. Cape Coral, Florida. The collapse of Florida's paradise is here. Cape Coral, once lauded as one of the brightest, most promising constellations in Florida's real estate firmament, offering alluring waterfront living, spacious lots, and the undeniable appeal of no state income tax, experienced an extraordinary, unsustainable boom during the post-2020 migration surge. Home prices violently soared from approximately $240,000 in 2019 to a wild, incomprehensible peak of $430,000 in early 2022, a staggering 79% increase. However, in 2025, Cape Coral is flashing every conceivable, screaming warning sign of an impending housing collapse, and the sobering numbers paint a grim, terrifying picture. Inventory is exploding, up an alarming 48% year over year, and homes are stagnating on the market for unconscionable months on end. Nearly 52% of active listings have already undergone at least one brutal price reduction, and the median home price has plummeted to approximately $390,000. Many experts are predicting a further devastating 15% to 20% decline by the end of 2025. The core reasons for this catastrophic trajectory are clear. Cape Coral is severely overbuilt, dangerously overexposed climate risks, and simply grotesquely overpriced for prevailing local income levels. The insurance crisis in Cape Coral is nothing short of a biblical devastation. Situated squarely within a high-risk hurricane danger zone, homeowners are facing premiums that are through the roof, with many now paying a staggering $7,000 to $10,000 annually just to insure a modest house.